If you were born before 1959, the moment you turned 67, the system quietly pulled you out of a whole category of bills, taxes and premiums that you are, statistically speaking, still paying in full. And nobody whose job it is to collect that money is ever going to ring you up and tell you to stop. I want to say this plainly right at the start because it's the single most expensive misunderstanding I run into year after year. Turning 67 doesn't just make you eligible for the age pension, it quietly reclassifies you in the eyes of the Commonwealth, your state government, your council, and a handful of other agencies, all of which are legally required to treat you differently from that point on. There are bills younger people still owe in full that you no longer do. There are taxes and charges that shrink, freeze or disappear entirely the moment you cross that line. But here's the catch that costs people real money year after year. Being entitled to a concession and actually not paying full price are two completely different things. The system doesn't refund you automatically. Nobody at the council mails you a check. The agency that's been collecting from you for 40 years isn't going to send you a card that says, "Congratulations, you can stop now." You have to know the concession exists and you have to apply for it yourself. That single gap between qualifying and claiming is the reason most people who are fully entitled to these benefits never see a cent of them. And before you decide this video isn't for you, let me clear up the biggest myth of all, because this is exactly how people talk themselves out of money that already has their name on it. Some people assume a list like this is only for pensioners doing it tough, so if you own your home outright and you're comfortable, you switch off, assuming none of it applies to you. Other people assume the opposite, that this is only useful if you've got real assets and a good accountant, so if you're living mostly on the age pension, you switch off too. Both groups are wrong, and both are leaving money on the table. Some items on this list help the pensioner living on a modest income the most. Others are worth far more to the person sitting on a home that's doubled in value over the last decade. For every single one, I'll tell you exactly who benefits most, so nobody watching can honestly say, well, that one's not for me. And if you're renting right now, don't click away either, because one item on this list quietly controls how fast your rent is allowed to climb. So let me tell you quickly who I am and why I'm the one telling you this. My name is Weston. I'm a licensed financial advisor specializing in retirement, aged care and estate planning. And for more than 15 years, I've sat across the table from Centrelink case officers, council rates departments and state revenue officers on behalf of ordinary families. And I'll tell you the most painful pattern I've seen in all that time. It isn't people trying to rort the system. Those cases are rare. The painful one is the honest person in their 60s, 70s and 80s who has done everything right their whole life and is still paying bills they were entitled to reduce or stop years ago, simply because nobody ever sat them down and told them which form to file. That's the most expensive kind of mistake there is, because it's completely invisible. There's no late notice, no penalty, no alarm going off anywhere. There's just money quietly leaving your account every fortnight, every year that never had to leave at all. So let's fix that right now. Today, I'm walking you through 5 of these, one at a time, in plain English, with the exact thing you need to ask for on each one. Then I'll give you a few bonus moves at the end for the homeowner with some real assets, because those last ones can be worth a small fortune and almost nobody talks about them. Stay with me to the end, because the 5th item on this list is the highest value one of all, and it also happens to be one of the easiest to claim. If you only act on one thing from this whole video, it's probably going to be that one. 1. The Commonwealth Seniors Health Card, and the income test almost nobody has rechecked. Let's start with the one that's most commonly written off before people even look at it. That's exactly why it's being missed. The Commonwealth Seniors Health Card is available to people who've reached age pension age but don't qualify for the age pension itself, usually because their income or assets sit just above the pension cutoff. Here's where I need to be precise, because this is where people get it wrong. The card is tested on adjusted taxable income, not your assets, and that income threshold was substantially increased a few years back and has kept rising with indexation since. A huge number of self-funded retirees who checked their eligibility years ago, got knocked back and never checked again, are now sitting comfortably under the current threshold without realising it. If you're single, with an adjusted taxable income under roughly the mid-90s in thousands of dollars a year, or a couple under close to $150,000 combined, you may well qualify. And those numbers move every year, so the figure that turned you away 5 years ago is not the figure in front of you today. Here's the part that surprises people. This card isn't means tested on your house, your superannuation balance in the pension phase, or your other assets the way the age pension is. It's an income test only, which means a genuinely comfortable retiree with a paid-off home and a healthy super balance can still qualify, purely because their annual income sits under the cap. And once you're holding the card, it opens the door to cheaper PBS prescriptions at the concession rate, a lower Medicare safety net threshold, so your out-of-pocket medical costs are capped sooner in the year, bulk billing incentives that make some GPs more willing to bulk bill you, and, in most states, access to the same energy, water and council rate concessions that pension card holders receive. Here's what genuinely bothers me about this one. The people it helps the most are the exact people least likely to check. The self-funded retiree who assumes concession cards are for pensioners and never looks again after being told no once. So the action here is simple, and it takes about 10 minutes. Go to your Centrelink online account through MyGov or ring Services Australia directly and ask them to check your current eligibility for the Commonwealth Seniors Health Card against this year's threshold, not the one from years ago.
Quick pause before we move on. If you're finding this useful, this is exactly the kind of thing I put together properly in the 2026 Australian Seniors Benefits Survival Guide. It's $5, it's got the checklists and document organisers, so you're not relying on memory for any of this, and the link's in the description if you want it sitting next to you while you make these calls. 2. Your council rates and state land tax. This is where the biggest dollars on the entire list are hiding, so pay close attention because there are actually 2 or 3 separate concessions stacked on top of each other here, and most homeowners don't have a single one of them properly on file. The first is the pensioner or eligible concession card rate rebate. Every state and territory in Australia runs some version of this, and in most cases it isn't automatic even once you're on the pension. In New South Wales, eligible pensioners can get up to a set amount knocked straight off their council rates each year. In Victoria, it's a percentage rebate off both council rates and separately off your utility bills. In Queensland, it's a rebate applied directly to your rates notice once you're registered. Here's where people get caught. Most homeowners assume this rebate kicks in automatically the moment they start receiving the pension. In most councils, it doesn't. You have to register your concession card with your council directly, usually with a simple form and a citing of your pensioner concession card or Commonwealth Seniors Health Card. Do it once, and in most areas, it stays on your account every year after, as long as your card stays valid. Miss it, and you pay the full rates bill every single quarter for no reason at all. The second one sits right alongside the first, and it's the one almost nobody asks about by name: rates and land tax deferral schemes. In several states, if you're an eligible pensioner, you can apply to defer your council rates entirely, with the state or council simply recovering the deferred amount, plus a modest interest charge in some cases, from your estate when the home is eventually sold or passed on. You keep every dollar of cash flow in your pocket right now, today, while you're alive to use it. And here's the part where comfortable retirees wrongly tune out. They hear the word pensioner and assume there must be a strict income and assets test they'll fail. But in some states, the deferral scheme is available more broadly than people expect, and it's worth ringing your state revenue office directly rather than assuming you don't qualify. So, who does all of this help the most? Honestly, everyone. The basic rebate helps the lower income pensioner the most in percentage terms, but the deferral option is worth a small fortune to the person sitting on a home that's tripled in value over the last 15 years, because they're the ones staring down the biggest rates bills as land values climb. And renters, I told you this one was yours too, and here's why. Your landlord pays that rates bill and passes every dollar of the increase straight into your rent. When rates are reduced or deferred for a huge share of homeowners in a community, upward pressure on rents eases as well.
Before item 3, one more quick mention. A lot of what trips people up with council and land tax concessions is just not knowing which form belongs to which agency. That's the whole reason I wrote the guide. 56 pages, $5, links below if you want the exact checklists for this section on hand. 3. Your Medicare and PBS costs and the safety net most people never track. This is the one quietly chipping away at your bank balance a little at a time, which is exactly why a lot of people never notice how much it adds up to across a year. If you're holding a pensioner concession card or a Commonwealth Seniors Health card, you already pay the concessional rate for PBS prescription medicines rather than the general rate, which by itself is a meaningful saving on every single script. But here's what almost nobody is told. There's something called the PBS safety net. Once your family's total PBS co-payments for the calendar year reach a set threshold, your prescriptions become free or close to free for the remainder of that year. For concession card holders, that threshold is genuinely reachable within a normal year of regular medications, especially if you or your partner are on several scripts. And separately, there's the Medicare safety net, which caps your out-of-pocket costs for out-of-hospital medical services once your specialist and test bills cross a certain point in the year, with concession card holders reaching that cap far sooner than everyone else. Here's what genuinely bothers me about this one, and it's why I'm spending extra time on it. Almost nobody keeps a running tally of where they sit against these thresholds. You pick up your script, you pay what the pharmacist tells you, and you never ask the one question that matters. On top of that, in most cases, your pharmacy is required to keep a safety net record for you automatically once you ask them to start one, so the tracking itself costs you nothing. And despite that, this remains one of the most underused protections in the entire system. Millions of pensioners who are within reach of the threshold each year never get the free or reduced cost scripts they were entitled to purely because nobody told them the safety net existed or how close they were. Who does it help the most? Anyone on multiple regular medications and anyone living mostly on the age pension. This is enormous for you. The action here is one conversation, not even a phone call. The next time you're at your regular pharmacy, ask them directly to confirm you have a PBS safety net record open in your name and ask where you currently sit against the threshold for the year. And while you're there, ask your GP or the pharmacist about the Medicare safety net threshold as well, because it usually travels right alongside it. That's 2 of the biggest healthcare cost breaks in the entire system, both unlocked by one conversation for someone taking several prescriptions a month. That's not pocket change. That can be one of the largest ongoing savings on this whole list, and it's sitting right there at your regular pharmacy counter.
Quick one before we keep going. The guide has a full page just for tracking your safety net progress through the year, plus an appointment tracker so this doesn't slip through the cracks. $5, link in the description. 4. Energy, phone and water concessions. Item 4 is smaller in dollar terms individually, but it's still a set of bills you can legally reduce, so I'm not going to skip past it. Every state and territory runs its own energy concession scheme for pension and concession card holders. The names differ depending on where you live, but they all do broadly the same thing, taking a set amount or percentage off your electricity account automatically once you're registered with your retailer. On top of the base concession, several states run a separate one specifically for medical heating and cooling costs if you or someone in your household has a relevant condition, and most states run a water rates concession alongside it as well. Separately, there's the telephone allowance for eligible pensioners who hold a home phone or internet service, a modest amount added directly to your regular Centrelink payment rather than deducted from a bill, but it's still money you're entitled to that plenty of people never activate. I'll be honest with you, this isn't the glamorous one on the list. No single part of it is going to change your life on its own, but here's how I want you to think about it. Each one is a recurring bill that the system already decided people in your situation shouldn't have to carry in full, and it sits there unclaimed for the same reason as everything else on this list. You only get it if you ask, and in most cases, you have to register your concession card directly with each retailer, not just with Centrelink. When you stack a few of these together, the small ones and the big ones, that's when the fortnightly number really starts to move. 5. The seniors and pensioners tax offset, which brings me to number 5, the one I told you to stay to the end for, because this is the item that quietly costs people the most year after year, and it's also the single easiest one on the entire list to fix. The Seniors and Pensioners Tax Offset, known to most tax agents simply as SAPTO, is a tax offset available to Australians who've reached age pension age and meet a fairly generous income test. Here's the part that surprises people. It doesn't just reduce your tax rate slightly. For a huge number of retirees on modest incomes, SAPTO combined with the existing tax-free threshold means they end up paying no income tax at all, or close to it, once their taxable income sits under the relevant cutoff for their situation. For a single person, that cutoff sits well above what most people assume the tax-free line to be. For a couple, both eligible, the combined offset is even larger. Here's the quiet trap. Because so much retiree income comes through as PAYG withholding on a pension, an annuity, or income stream from super, plenty of people keep having tax withheld out of habit, or their fund defaults to a standard rate without SAPTO ever being properly applied through the year. They lodge a return, eventually get the money back as a refund months later, and call that normal. In my experience, this is the most common and the most fixable money mistake people over 67 make in this country. What I think most people don't understand is that the tax system isn't trying to hide this from you out of malice. It's just that no part of the system is set up to walk over and tell you. The easiest move you can make is this. When your tax return is prepared this year, confirm with your agent or check yourself if you lodge online that SAPTO has actually been applied and that your date of birth is correctly recorded, because that's what triggers eligibility. Then ask whether the amount being withheld from your pension income or super income stream through the year should be adjusted downward to reflect it, so you stop handing the tax office an interest-free loan every fortnight and start keeping that money in your own account where it belongs. It's not a fight with anyone. It's a box that has to be ticked correctly, and it's worth checking every single year, not just the year you turn 67.
Before the bonus section, if you want all 5 of these laid out with the exact wording to use when you ring each agency, that's in the guide too. $5, links right there under the video. A few bonus moves for homeowners with real assets. If you do have some real assets, let me give you a few bonus moves that almost nobody ever hears about, because for the right person, these are worth more than everything else on this list combined. The first is the downsizer contribution to superannuation. If you're 65 or older and you sell a home you've owned for at least 10 years, you and your partner can each contribute up to a substantial amount from the sale proceeds straight into superannuation outside the normal contribution caps, and it doesn't get taxed going in. For a couple sitting on a family home that's appreciated enormously, this is one of the single biggest legal moves available to shift wealth into a lower tax retirement environment. And a huge number of eligible retirees have simply never had it explained to them properly. The second is the Home Equity Access Scheme, previously known as the Pension Loan Scheme. It's a government-run reverse mortgage of sorts, letting eligible retirees draw a regular fortnightly income stream, or in some cases a lump sum advance, secured against the equity in their home at a modest government-set interest rate, with the amount owed simply settled from the estate later on. It exists specifically for the asset-rich, income-poor retiree who owns a valuable home but doesn't have the cash flow to match it, and it's one of the least talked about programs in the entire retirement system. The third is the surviving spouse carryover. When one partner passes away, pension entitlements, concession cards, and rates concessions don't always transfer automatically, and families lose them by accident during an already difficult time. If you file the right paperwork promptly with Centrelink and your council, the surviving partner can often retain concessions and avoid a sudden jump in costs in the worst possible year to face one. And the fourth is one people laugh at until they add it up. In every state, once you hold a seniors card or a pensioner concession card, your vehicle registration is reduced, and in some states it's waived almost entirely. It's small money every year on its own, but it's your money, and it's sitting there. Margaret's story. Let me bring all of this back to a real person. I once worked with a woman I'll call Margaret, 74 years old, living just outside Ballarat, a widow in a paid-off home that had quietly doubled in value over 15 years, getting by mostly on the age pension and a small amount of savings interest. When we sat down and looked at her situation, here's what we found. She'd never registered her pensioner concession card with her council, so she was paying the full rates bill every quarter. She'd been told years earlier she wouldn't qualify for the Commonwealth Seniors Health Card and never checked again after the threshold rose. And her pharmacy had never opened a PBS safety net record in her name, despite her being on 4 regular medications. All 3 at the same time, and every single one of them was something she had the right to fix. So we made 3 phone calls. 1 to her council to register her concession card, 1 to Services Australia to reassess her seniors health card eligibility, and 1 to her regular pharmacy to open her safety net. Nothing about Margaret's life changed. She didn't move house, she didn't sell anything. The only thing that changed was how much of her own money stayed in her account at the end of every fortnight. And here's the part I want you to really hear. She wasn't gaming the system, and she wasn't getting away with anything. She was simply finally claiming what she'd already earned over a lifetime of doing everything right. That's the entire point of what I'm telling you today. Being entitled to a concession and actually keeping the money are 2 different things, and the only bridge between them is the form. The agencies aren't going to build that bridge for you.
One last mention before we wrap up. Everything Margaret and I worked through, the exact checklist version, is in the 2026 Australian Seniors Benefits Survival Guide. 56 pages, printable, $5, link in the description if you'd like your own copy sitting on the kitchen table for this. What to do this week? Here's exactly what I want you to do this week, and none of it costs you $1. First, ring your council's rates department and ask by name whether your pensioner or seniors health card rate concession is currently registered on your property. If it isn't, ask what form adds it and what you need to bring. Next, log into your MyGov account or ring Services Australia directly and ask them to check your current eligibility for the Commonwealth Seniors Health Card against this year's threshold. Then, next time you're at the pharmacy, ask them to open a PBS safety net record in your name if you don't already have one, and ask where you currently sit against the threshold. And finally, the next time your tax return is prepared, confirm that SAPTO was actually applied and ask whether your withholding through the year should be adjusted to reflect it. And if the cost of paying someone is part of why you've been putting this off, there's genuinely free help available. The National Tax Clinic program, run through participating universities, offers free tax help for people on a low income. And financial counselling services, funded by the National Debt Helpline, can walk you through concession applications at no cost at all. So for most of you, the cost of finally catching every one of these is nothing. That's it. A few phone calls and a couple of forms standing between you and money that has been yours all along. If this one caught you off guard, there's another video right here on the channel where I walk through the council rates and land tax deferral schemes in far more detail, state by state, because the rules genuinely differ depending on where you live, and I don't want to leave anyone in the wrong state guessing. The card for it is on screen right now. One last quick thing, and it matters. This is general education, not personal, financial, or legal advice. These rules really do vary by state and territory and by your individual income and assets, so always confirm your own situation with Services Australia, your local council, your state revenue office, or a licensed financial advisor before you act. And if anything here helped you, do one thing for me in return. Send this to one person you know who's over 67. It won't cost you a thing, and it just might put a few $100s a fortnight back in their pocket. And if you want everything from today organised in one place, the 2026 Australian Seniors Benefits Survival Guide is linked below for $5. I'll see you in the next one.